Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 215 of the Independent Advisors Podcast, where Mark McEvily and I, Matt Jessup, bring you everything you need to know from the past week in the world of the financial markets and financial planning. This week, we're blessed to have Aaron Kramer with us, Wealth Advisor of Jessup Wealth Management, CFP extraordinaire. Welcome, Aaron.
Thank you. Happy to be back again.
I'd love to have you here. As the current date, it's August 24th, and Mark's wife is starting to have contractions closer together, so baby McEvily is on the doorstep.
That's amazing.
Yep.
I know he's excited.
Yep. By next week, we'll have an update for all of our listeners and viewers after baby McEvily arrives. So as always, Aaron, we're going to start and review the performance of the major market indices that we track for the month and the year, and this data is from Y-Charts, and it is as of this morning on August 24th. We'll start first with the S&P 500. S&P 500 index month to date down 3.3%. Year to date, it's up 15.5%. The Dow Jones Industrial Average down 3.1% for the month, up 4% year to date. The NASDAQ Composite Index down 4.4% for the year, up 31.1%. The iShares Russell 2000 ETF down 6.5%, Aaron, and still up 6.6% for the year. And the Vanguard FTSE All World ex-United States ETF for the month down 5.3%, and for the year to date, matching the small cap index, up 6.6%. You know, I think what you're seeing is kind of this risk off in the market.
Yes.
And, my comments before I talk about bond pricing, the market seems to be stabilizing over the last couple of days after profit taking hit the market the first 2 weeks of August. I know Mark has discussed on the podcast previously about the seasonality of the market. He shared that historically in pre-election years, the market tends to be weak in August and September before rallying in Q4. The question is, will history repeat itself?
Right.
That's yet to be seen. However, what's very interesting is so far the script seems to be playing out.
It does. It's been a very, very weak month so far, and I think it's a lot of profit taking and what Mark has mentioned in the past. It's just seasonality.
Yeah, and if you look at it, you had May, June, July where we're strong. A lot of people were underallocated to stocks. We talked about that on the podcast. And now you have an opportunity that if you and I've said this many times over the past a couple of weeks, if you are underallocated to equities and
Right.
you are waiting for a correction in the market, you're getting your fatter pitches now.
Right.
And just make sure that, again, you're investing in line with your goals and objectives, risk tolerances, et cetera. But if you're underallocated to equities and you know this,
Might be a good time.
something to look at.
Yep.
So let's talk about bond pricing, Aaron. 3-month Treasury yields currently sits at 5.57%. 2-year yield on the Treasuries, 4.95%. And the 10-year, 4.19%. I know there's been a lot of headlines on that 10-year as it's been creeping up. I think the narrative in the market is inflation going to come back, right? Is it
Right.
going to kind of reaccelerate again?
Exactly.
So this leads me perfectly into big headlines for our listeners and viewers. The first thing is the Federal Reserve. So we have the annual Jackson Hole meeting. It's formally known as the 2023 Economic Policy Symposium, and it's held beginning today, August 24th through August 26th. All eyes on this. Narrative in the market is changing from when will rates peak to how long will they stay here before they start to cut.
Yeah, I think that's the big question for a lot of people is when are they going to start to pull back on rates?
And you're seeing that narrative change too, aren't you?
Absolutely. So it's gone from there's a chance there's more rate hikes by the end of the year to when are they going to cut?
Yeah.
So I think that's the most likely scenario is they pause for the rest of the year and maybe we have rate cuts maybe mid next year would be possible.
Perfect you saying that. I have a piece, I believe it's from Goldman Sachs,
Okay.
that has their forecast for when the first rate cut will come.
Okay.
So we'll be
Good.
talking about that.
Good.
Okay. Next kind of big headlines, earnings season's pretty much over. We'll start the banter on the topic again in mid-October, which will be here before we know it.
Yes, it will.
I want to reiterate this because this is where you get the real news ahead of time. I've mentioned this before on the podcast. We're going to be watching the American consumer very closely in Q4 because student loan repayments are going to be starting up this fall.
Yes, they are.
Right? And that could eat up upwards of someone's 10% of their income.
Oh, absolutely.
So that's something that if we think about earnings season coming up, think of the banks. The banks tend to report early in the earnings season. Think of the big boys like JP Morgan. They tend to make comments on their consumers.
Right.
Right? And then we get to later in October, we're going to hear from a lot of the big retailers, Target, Walmart, Costco. I want to make sure the American consumer is holding up going into the holiday spending season.
Yeah, and I think Q4 and Q1 of next year might be a big tell on how strong is the consumer really with these student loan payments coming back.
Exactly. And so the last little piece I have, and I think you're going to find this interesting because I did. Okay, this kind of surprised me. Okay, the Atlanta Fed GDPNow forecast for growth in the current quarter we're in, which is continually revised based upon incoming data, it jumped to positive 5.8% annualized as of Wednesday, so yesterday, well above the official second quarter growth rate of 2.4%. While most expect the actual growth rate in the third quarter to come in substantially lower, the Atlanta Fed's blue chip survey of economists indicated that most are also steadily revising higher their growth forecast.
Wow.
So I wanted to bring this up because this narrative over the past 9 to 12 months has been 2023 is going to be a horrible year.
Right.
And as each quarter we keep going through, guess what? It's a little stronger than we expected.
I know. There's been the recession talks the second half of this year, and we haven't seen it. So.
Forecasts are starting to take that slowly off the table, right?
Absolutely.
And it's like now they're like, okay, well, the risk is there in 24. But, we're going into that presidential election year, and we know both sides of the aisle do it.
Nobody
what are they going
wants
to do?
A recession that year.
Yeah, they're going to juice up the economy one way or another.
Absolutely.
Right? All right, well, let's transition to tweets, articles, and research that caught our eyes this week. Aaron, why don't you start off for us?
Absolutely. First one is going to be a tweet from Bespoke Investment Research Group on August 23rd, yesterday, and it's surrounding the energy sector and 50-day moving averages. So the tweet says, one of the sectors is not like the others right now. 91.3% of energy sector stocks are above their 50-day moving averages. 30% of S&P 500 stocks are above their 50-day moving averages, and less than 10% of real estate and utility stocks are above their 50-day moving averages.
This is interesting.
It's very interesting. What are your thoughts?
So, the 50-day moving average is a good kind of temperature check on, what is the health of a sector, right? And, do you have, healthy, trading in that sector, or is it under pressure?
Right.
And I think energy was obviously in vogue in 2022.
Absolutely.
Best performing subsector of the market. So I think what you have now is OPEC is doing the best they can just to get oil prices higher.
Absolutely.
Right? They've cut production, okay? Ultimately, I think there's more upside risk to oil than there is downside risk. And I'm using my wording very cautiously on this because oil's very volatile.
Absolutely.
Right? I just feel that supply is tight. I've already began to work on my show notes for episode 216 next week. I have a piece teed up from the IEA, the International Energy Agency, that shows their forecast of supply versus demand. And it's supposed to, demand's going to begin to outstrip supply going into later this year.
Oh, wow.
And so that's just their forecast.
Okay. So you think energy could potentially remain
again,
strong?
that leads me to say I think there's more upside risk to the price of oil than there is downside.
Interesting.
And see, part of my piece next week is to try to peel back the onion. Why are gasoline prices so high right now relative to the price of oil?
Right.
And I have a piece that explains that. I'm not going to steal my thunder from
We won't steal next week's notes.
But it's going to be very interesting. But I like how you highlight this because the other thing, if Mark were sitting here and you said this, what Mark would say is, this sector rotation is healthy for the market. Right? And what he would say is, you had technology lead in May, June, July. Tech is probably one of the worst performers in the last 3 weeks.
Right.
And you're having now this sector rotation. And so, Mark would sit here and say, as our chief investment officer, that's the lifeblood of a bull market.
Absolutely. And I think it makes sense with the seasonality that we're in right now. We're
Correct.
seeing some of that rotation out of technology and the growth areas back into value and energy
Yes.
a little bit.
Yes.
So,
Good piece.
yeah, I thought it was pretty
And
interesting.
Bespoke always has quality stuff.
Fantastic
I
stuff.
love subscribing to their research.
All right.
And we don't get compensated for that. Jenna, our director of marketing, I'm going to throw it out there. We're not compensated for that comment.
We are not.
Yet, hopefully.
All right, I'll go on to my second piece here. I have a tweet by Carl Quintanilla on August 22nd, and it is used car prices. So he tweets that media articles this week further support the view that forward inflation pressures are ebbing faster. New hire pay declining versus a year ago. The surge in auto loan delinquencies. We previously wrote how used car prices could fall another 30% from here. So he has a chart of the used car prices going back to 1997. That is from Bloomberg. So it shows a pretty extreme jump throughout COVID, right? So we all kind of remember that.
All the supply constraints, couldn't get chips.
Absolutely.
People were leaving big cities. They didn't own a car before. I mean, all those pressures.
So we've seen the last year or so, used car prices have come down fairly significantly. What would you say that is, 10%, maybe a little bit more?
Yeah.
But his chart here draws a line, and he's forecasting essentially that it could fall another 30%, and that would kind of get back on long-term trend average. So
This is an interesting chart. So as a reminder for our traditional podcast listeners, these charts are going to be available on our social media sites. So Twitter, LinkedIn, Facebook, etc., Instagram, all of our charts will be there. Jen, of course, put this up for our YouTube viewers. You know my immediate thought when I see this? It makes me think about prices are probably going to come in a lot quicker than people expect. In addition, I saw this on Twitter, there's a guy we talked about before. He's called the car sales guy.
Oh, yeah.
And this guy has like tons of followers, okay? He's saying that in his network, repos are up through the roof.
I believe it.
Repos are just through the roof. He also commented that Ford has patented, ready for this?
I'm ready.
A chip that goes into the car that when you don't make your payments,
They shut it down.
it disables the car.
Oh, my goodness.
How crazy is that?
Doesn't surprise me. That's pretty...
Technology
That's
working.
nuts. That's nuts.
But, ultimately, this is good for inflation.
Absolutely.
Okay?
Absolutely.
Now, if you're a used car dealer and you got a bunch of inventory in the lot,
This is not good.
Not so good. The other observation I have is this. I have traveled some this summer. Every time I've rented a car, the rental car lot is virtually empty.
Yes.
And yesterday, I did a day trip to Missouri. So I land in St. Louis, go to the rental car, and the guy has to get on the radio and say, "What cars just came back?" And he sits there and says the cars, and he looks at me and goes, "You get an upgrade." Because
that's all they have.
That's all they had. And so that just says the rental car agencies, they're lean on inventory
Right.
as
But
well.
It shows you they're not adding new inventory.
They're not
purchasing
buying.
cars. And
Yeah, they're trying to
it's
get by
probably
what they
interest
got.
rates. Exactly.
Right? Well, I think this is good for inflation.
I do,
Because
too.
at the end, it says hashtag CPI.
Yes, it does.
Right?
That's a good one. I got one more for you.
Okay.
So, tweet from Jason Gopfert. I probably butchered that pronunciation, and it was on August 21st.
You know I'm the last person to help you.
Yeah, I know. I wasn't even going to ask you.
Don't ask me.
The reason I saw
I
this
love you,
is,
but I'm not going to help you in this.
Ryan Dietrich reposted this, so that's how I found this. Always love his stuff. On August 21st, it's the 10-year making a 10-year breakout. And the tweet says, I don't know, a 10-year breakout and the 10-year yield doesn't seem like the most bearish thing.
So you are highlighting the 10-year.
I am.
Love it. It is the talk of the treasury
It's the
market
talk
right
of the
now.
town right now. So you were right with your headlines.
I didn't know you had this.
The S&P was higher 6 months later every time the 10-year broke out of a 10-year base.
Say it again.
The S&P was higher 6 months later every time, 100% of the time. 6 months later after the 10-year had an all-time or a 10-year high.
I'm going to cheat here. The data set on this is quite extensive. It goes back to 1962.
Yes. And he says it didn't work out well from 1870 to 1920. I'm not going to read the rest of that, but it's kind of a funny tweet there. So I think this is extremely interesting because typically you think the 10-year going up, it's a risk off, right?
Yeah. Well, I mean, I remember specifically very, very earlier in the year, the end of 2022, when that 10-year was getting close to 4, everyone was losing their minds.
Right. But it breaking out after 10 years, 100% of the time, 6 months later, the S&P 500 was positive. I think that's extremely interesting.
That's extremely interesting. I mean, I have to put on my compliance hat, past performance is not indicative of future results.
Absolutely.
However, at times it could be a guideline, something to keep an eye on, right? Doesn't necessarily mean the market's going to be higher 6 months from now, but the data set's compelling to me.
It is very interesting.
I didn't expect this.
Why not? Or
I didn't expect the correlation to be 10-year yield breaking out and the stock's doing good.
Yeah, I think it just goes to show you that rates going up, the stock market can continue to do well. We've said that so many
Aaron,
times.
I love it. Because you had a piece, 3 weeks ago about that?
Yes. Yep.
Because
I'm on my 10-year trend.
I like it. Because you were dispelling the narrative of high interest rates or interest rates moving higher or being high relative to recent history, tends to people perceive that it's bad for stocks.
Right.
And you talked about that's not necessarily the case.
Absolutely. 100%. So we have more data on that. I love it.
Interesting. So again, it goes back to this narrative you're going to hear a lot over the next couple of quarters. How long does the Fed keep the Fed funds rate at this level, right?
Right. Absolutely.
It's going to be the narrative. Anything else, Aaron, before I take over?
That's all I got.
All right, so I got a couple pieces. First one's going to be really interesting, okay? This is going to be like deep thought, okay?
Okay.
So this is an interesting viewpoint about China helping the U.S. control inflation. Seems kind of weird, right? Mm-hmm. So this is from Yardini. He does a lot of research, like a raw research firm. Think of like Bespoke, okay? So this was also a tweet from Carl Cantanilla. He is a CNBC anchor, and the only reason I know how to pronounce his name is I've watched it for years and years, okay? So China and the U.S. have a dependency on each other. So this is an interesting viewpoint, okay? This is what Carl said, quote, "The gift from China that keeps on giving," says Yardini. "Chinese exporters benefited greatly from the goods buying binge in the U.S., but they've been forced to lower their export prices, reducing the risks that the U.S. must fall into a recession to bring down inflation." Now, Jenna's going to put up this chart for our YouTube viewers. This will be in our show notes. This chart says the source is the Bureau of Labor Statistics and the China National Bureau of Statistics. And it shows U.S. import prices from China versus China PPI. And it shows the yearly percentage change. Again, why am I highlighting this? The Chinese right now are going through an economic slowdown. The last thing that they need is the U.S. going into recession.
Right.
It's the last thing they need.
We're extremely dependent on China from goods perspective.
And so what they're doing is they're like, okay, well, I got to keep selling. We still need to have economic activity. We're going to take a haircut. We're going to take a discount.
Lower prices.
Because I don't want my main customer to go into a place where they can't keep buying from me. I found this piece
very surprising,
super interesting.
It makes a ton of sense.
I don't know. It kind of took me back when I kind of saw this piece.
It's surprising, but I think it's fascinating.
Smart on their part.
It's very smart.
Now, I haven't been as close attuned to what's going on in China as Mark is here at the office, but I do know, and I can say, they've been doing more economic stimulus within their country.
Gotcha.
They've been lowering their benchmark lending rate, etc.
Okay.
Because they're trying to spur some economic activity. I think they're going through a little bit of a soft patch.
Gotcha.
I would say.
So they're already in the rate cut cycle at this
They've
point.
started it, sir.
Say. Yeah.
They started it. All right, you talked about interest rates, okay? So this is a piece from Goldman Sachs regarding interest rates, AC. This is what it says, and this is a piece from Goldman. Quote, "Our baseline forecast calls for the FOMC, that is the Federal Reserve, to start cutting the Fed funds rate in the second quarter of 2024. We are penciling in a 25 basis point cut, that's 1/4 of 1%, cut per quarter, but it could come more quickly."
Okay.
It could
so
cut
that
more
would
quickly.
theoretically, that would put rates around 4.5 by the end of next year.
Yes.
Okay.
Exactly. So, and he continues and says, if it is more confident that the inflation problem is unlikely to return. So I've mentioned this on the podcast before. I'm going to do it again. A site I really like going to, and any of our listeners and viewers can do this, Google Truflation, Truflation, Truflation.
It's a great site.
Great site. So what people don't understand is the CPI is a survey. They're not taking real-time data. Like, can we get in the year 2023, please, Fed?
No, they won't.
This is the way we've always done it, and if we change it, people are going to think we're manipulating the numbers.
Right.
That's the narrative.
So they have stale survey data.
They do, and the real-time inflation data is showing mid-twos, and the government's numbers 3.2. Right. So I thought this piece from Goldman was interesting because they're one of the first I'm seeing sticking their neck out there and actually putting a quarter with it.
Yeah.
That's why I wanted to highlight it.
I mean, I tend to agree. I don't know. We shall see.
I thought it was interesting.
It's very interesting.
So this is going to be a nice little round table between you and me, my last
right.
piece.
I love stuff like this.
All right,
I
here we
looked ahead
go.
A little bit.
Just hunker down for this. The magazine cover. Is it a market tell? So this piece is from a magazine called Money Week. And on the front cover, it actually boasts that it is Britain's best-selling financial magazine. Okay? So this is a post from J.C. Peretz, one of the friends of our podcast from All Star Charts. He posted this on August 13th, Aaron. This is what it says. Quote, child robot is racing across the floor of the NYSE, riding a bull while throwing sheets of paper with tablets and graphs at adults wearing suits with ridiculous smiles on their faces. Things you see near bottoms or things you see near tops. And the cover says, run with the bull. Is your portfolio poised to profit? Page 20.
Wow.
I'll let you start on this.
I mean, historically or theoretically, when I see stuff like this, it would signal the exact opposite to me. In this scenario, I tend to think the market could do higher as long as corporate profits are strong.
Yep.
But usually when I see stuff like this, usually I think of the market bottom. Like, this is the worst period in economics and the market's terrible. And what does the market...
Is it time to go all bonds?
I'm usually contrarian
Yes.
Of stuff like this. But I don't know. What are your thoughts?
The thing that it gets me is if I thought we were kind of near kind of a market top, I could play into this, but
Right.
I don't when I look out a couple years, kind of big picture.
Yeah.
What this kind of says to me is this is screaming to those people that are either A, still out of the market from 2022, or B, severely or minorly underallocated to equities.
Yeah.
And it makes me think of about a month ago, maybe 2 months ago at this point, I highlighted some research from Bank of America. They do their fund manager survey, and it shows professional, active portfolio managers and their biasy towards stocks or bonds.
Right. Because most of them are severely underweight equities at this time.
They are. And let's take a step back and talk about why. So you go through 2022, their shareholders, the mutual fund holders of their funds,
Right.
saw way too much downside volatility. So what's one way that they keep investors on the boat? They lower their risk footprint.
Right.
Less volatility in the fund. Now that works great when the market's not doing well. But what happens to you when May, June, July comes around this year and the market runs and your mutual fund's underperforming? They got to start buying more equities.
Right.
But this isn't like they can turn on a dime.
No, it takes weeks
these
and
funds
weeks and
have
weeks.
billions. It takes weeks for them to turn the ship.
Right.
So to me, this is screaming out to the people that are underallocated to equities. That's what it says to me.
Yeah.
However, the cover is a little funny.
It's a bit goofy.
It's a bit goofy. I guess the other thing that screams to me is this this market focus on AI.
Yes, absolutely.
And you've seen this fixation with how is AI going to change the landscape over the next 5 to 10 years? Everything from employment, productivity, corporate profits you were alluding to.
Right.
And I think it's going to be really interesting. Obviously, that's why, in my opinion, tech is one of those better performers year to date.
Absolutely.
Because you now have a lot of optimism behind this topic.
Yes, absolutely. And it's interesting. You see that trend this year for sure.
You do.
With AI. I don't know. It's a good one. I like that.
I always like the magazine covers. They're always interesting. So anytime I'm leaving, we have a local grocery store here in Dayton. I absolutely love. And as I'm walking out, I always kind of catch what the cover of Barron's is on the weekend, right? And it always is like, okay, well, it's the top of that.
Yep.
Every time they have the
That's
cover.
Funny. That's funny.
Before we disconnect from episode 215, Aaron, anything you want to leave our listeners and viewers with this week?
Only thing I'd say is that with the seasonality going on and the market being a little weak to start this month, I would just say it's not a time to make major changes. It's a time to hold steady, stay at your risk tolerance, and we'll get through it.
Love that advice. So we'll be back next week for episode 216. We'll give you guys an update on the McEvily family. I have a feeling baby McEvily will be here in the next 24 hours, which we're all excited about. And that's all I have. So myself, Aaron, Jenna, we appreciate you listening to episode 215 of the Independent Advisors Podcast. We hope the rest of the week goes well for you, and we'll see you next week for episode 216 on Thursday.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.